Hello everyone. I'm going to spend some time covering depreciation using some definitions and principles that support the concept of depreciation. We'll go through several examples and show the impact of depreciation on the income statement and the balance sheet over time. The key concept behind depreciation is where an asset is recognized over the useful life of the asset. Imagine buying a piece of equipment for your company. Do you expense it all in the first year? Since its useful life is 5 years, do you expense it over those 5 years? What are the applicable accounting principles and the standard handling of these purchases in accounting? The matching principle states that where expenses can be matched with revenues, we should do so because the benefits of an asset should be linked to the cost of the asset. We're going to be looking at net book value, which is the original cost of the asset less any accumulated depreciation. The asset example we'll use is a forklift. A compressed gas forklift costs approximately $25,000 new and has a useful life of 5 years. In this example, the forklift will be used in a facility that has multiple shifts over the 5-year period. The company will pay cash and record the forklift as a fixed asset in year 1. First, we're going to show in example 1 how straight line depreciation is calculated. We take the historical cost of the asset, which is $25,000, and we'll divide it by the 5 years to get the $5,000 per year. You'll see the graphic representation of a straight line over the 5 years, meaning it will be equal over each period of time. In accelerated depreciation, calculated at the very bottom, it's called sum of the year's digits. You apply 5/15ths of the cost the first year times 25,000 is 8,333, and so on all the way down. And then you'll see on the graph the gray line starting high in year 1 and going down to well below the straight line depreciation in year 5. Those are the two most common methods of depreciation. On this screen, we're going to go over the balance sheet values of this forklift. In example number 1, the straight line, you'll see at the bottom there, the cost is $25,000 per year, the same over the entire period of time. The accumulated depreciation starts at $5,000. It grows evenly each year by $5,000 up until year 5, where the net book value is 0. The accumulated depreciation, accelerated depreciation, starts at a higher amount, 8,333, and then starts accumulating all the way down in year 5 to 0. And you'll see in the graphic representation of the net book value of these assets, it starts up at 20,000 and it decreases on a straight line basis. The accelerated is more of a curved line showing the acceleration of depreciation in the earlier years, and then it slows down. Well, that's it for our overview of depreciation. You'll need to cover this in Chapter 10 and do problems 1 through 10, and we'll go over them in the next class. Thank you.